Hello friends, welcome to FinSights. I take the opportunity to wish you all a very happy Dussehra. While going through our website safalniveshak.com, I came across the idea of making this video. As per the Hindu tradition, today marks the victory of Lord Ram over demon Ravana. A negative interpretation of Ravan's 10 heads are in 10 emotions or senses in humans. When it comes to investing, some of these emotions stand in between the investor and his long-term success. No investor can claim to master or kill these demons, but a knowledge of these residing within you is pretty helpful. So let's talk about these demons that reside in our mind. 1. Overconfidence. Overconfidence can be harmful to investors' ability to pick stocks over the long term. Overconfident investors typically execute more trades as compared with their less confident counterparts. While confidence can be a beneficial thing, overconfidence is often detrimental. A research shows that traders conducting the most trades tend to, on an average, actually receive yields significantly lower than the market. Second, arrogance. See, friends, there are two kinds of traders. One, those who are humble, and second, those who are going to be humbled. In the markets, competence must come before confidence, or the markets will give you an expensive education. No one can predict the future prices of the markets. The stronger the belief that you can, the harder it is to exit a position where you are wrong. Have confidence in your trading system and your discipline to execute your trading plan with discipline. But also be humble and take your planned stop loss when the market shows you that your trade entry is likely not going to work out as a profit. A famous quote goes like this: there are old traders and there are bold traders, but there are very few old, bold traders. Third, envy. Most people come with a psychology of getting richer faster than others. We need to understand that in the stock market, we are not racing with the rest of the world. Rather, we are competing with ourselves, our previous versions. Fourth, greed. So often, investors get caught up in greed, that is, excessive desire. After all, most of us have a desire to acquire as much wealth as possible in the shortest amount of time. Fifth, fear. Fear is probably the most significant emotion for traders. Many traders struggle with the emotion, and fear can demobilize you from applying your hard-learning technical skills. Significant trading losses often lead to emotional distress and turmoil. Unless addressed, the trader may re-experience those painful memories in the future trades. When suffering from fear, you may cut winners short in fear of giving profits back, or maybe hesitate in pulling the trigger because you fear the prospects of a loss. Sixth, ego. There are a lot of reasons people fail to become master investors. The usual suspects are fear and greed, but there is something that isn't discussed much. That is ego. A big ego is a major problem for traders, and it stops them in particular from selling losers. Selling a loser is very bad for the ego, and many just can't cut losses. Friends, cut the losses to make the money. Seventh, gluttony. Gluttony refers to overindulgence and overconsumption, but in the financial markets, gluttony often rears its ugly head in the form of overtrading. Overtrading is the excessive buying and selling of securities in order to compensate for losing positions or to generate more earnings, and it's extremely common amongst new and inexperienced traders. It also appears in portfolios that have generated weak or inconsistent earnings. Eighth, illusion of knowledge. When it comes to stocks and the economy, the illusion of knowledge can be disastrous. Many complicated situations tempt investors to believe that they know the answers, but the reality is that the moving parts are too intricate. There are too many variables, and the outcomes are anything but certain. Ninth, wrath, that is madness. Wrath is a strong word, but it's necessary to use it when we are to understand what ignoring diversification could bring. Diversification is the key to value investing because it allows you to embrace patience and be comfortable with your investment decisions. Don't let wrath overcome you, but rather diversify and limit your liabilities for stable but great returns. Last but not the least, herding, that is herd behavior. It represents the tendency of an individual to mimic the actions of a larger group, whether those actions are rational or irrational. All investors feel some temptation to follow the latest investment trends. However, investors who steer clear of the herd and maintain their own independent strategies and investment principles are likely to avoid the heartbreak that can come with being involved in an investment trend gone wrong. The best advice is to always do your homework before buying into any trend. Investing or otherwise, we all have demons inside of us. It's our choice how many of them we feed and how often. The idea is to know and accept that they exist, and then learn to tame them before they eat us and our investment returns. What do you say? Which of these demons do you feed more often? Share your thoughts in the comment section of this post. Again, wishing you all and your loved ones a very happy Dussehra. Thank you so much, guys.